Okay, so for our discussion, this day we're going to have IAS 20, International Accounting Standards number 20 for government grants and government assistance. So that's accounting for government grants and disclosures for government assistance. So for our discussion, these are the topics that we're going to be having. We'll be discussing the scope, the definitions, everything related to government grants or government assistance also, and then disclosure. So these are all the items that we're going to be discussing for this particular topic. Okay, so for the scope, basically the standard will focus on how we are going to apply or how we are going to account for government grants. And in the case of government disclosures, how we are going to disclose the following items. So of course, we're going to discuss the difference between government grant and government assistance. But if you see from the scope, it talks about accounting for the grant and disclosure for the assistance. The basic reason is because government grants are generally directly affecting our business. So meaning we can account for the direct impact of the grant to our entity or to our business. While in the case of government assistance, since it is a general help that is coming from the government, it is difficult for us to be able to determine the direct impact or the direct monetary impact of that assistance. So therefore, we cannot account for it as an asset or as an income or what have you because of this particular limitation. The mere fact that we cannot account for the direct impact or the direct monetary impact of the assistance. So for the scope, the standard basically covers all government grants and government assistance except for those that are specifically provided from A to D. So first is the special problems arising in accounting for government grants in financial statements reflecting the effects of changing prices or in supplementary information of a similar nature. So in that case, when it comes to the specific changes or the effects of the changing prices in government grants, it is not going to be covered by um, this standard IAS 20. Rather, it is going to be covered by the specific standards that are focusing on measurements, such as the fair value measurements in IFRS 13. If there will be involvement such as translation adjustments, because it is possible that the government grant comes from a foreign government, so there will be differences in the values or the price changes, then that will now be covered by the specific standards. Okay. Letter B, government assistance that is provided for an entity in the form of benefits that are available in determining taxable profit or tax loss, or are determined or limited on the basis of income tax liability. Examples of such are income tax holidays, investment tax credits, accelerated depreciation allowances, and reduced income tax rates, because this letter B is covered by your income taxes already. Or generally, it is going to affect the liability that we're going to pay. So in that case, it is going to be covered by IAS 12 already. Letter C, government participation in the ownership of the entity, because that's not really considered as a grant, but rather it now covers government-owned and controlled corporations, which is not part of the standard anymore. And letter D, government grants covered by IAS 41. We already discussed this when we were discussing IAS 41. The mere fact that it is already covered by IAS 41 means that it is no longer going to be covered by IAS 20. So with that, let us proceed to the definitions. So the first definition pertains to government. So government refers to government agencies, and other similar bodies, whether local, national, or international. So just like what I said, it is possible that the grants provided to the company is under the local government, meaning pertaining to the LGU, local government unit. The national government so in this case in the Philippines, it's going to be the national government of the Philippines, or international, meaning any grant given by any foreign government. Let's say, for example, the government of Singapore, the government of Korea, or whatever, that are granted to a specific entity in the Philippines. So that's what we pertain to the government here. Next, we talk about government assistance. So government assistance pertain to actions by the government designed to provide an economic benefit specific to an entity or range of entities qualifying under certain criteria. Government assistance for the purpose of the standard, which is IAS 20, does not include benefits provided only indirectly through action affecting general trading conditions, such as the provision of infrastructure in development areas or the imposition of trading constraints on competitors. Okay? So it does not include benefits provided only indirectly. Okay? So this simply means that similar to what we discussed a while ago, government assistance cannot be accounted for as a specific benefit for a specific entity only, because it is generally provided for a certain group. So most of the time, if not all of the time, government assistance is not accounted for as a specific asset or income on the financial statements of the entity, because there is no direct monetary amount that we can put in that particular assistance. And take note, when you talk about government assistance, it is not limited to those that are trading related or infrastructure related. All types of government assistance that will help the business. Next, we have government grants. Government grants are assistance by government in the form of transfers of resources to an entity. So this is the main difference between grants and assistance. So a grant is certain resources that are being transferred from the government to another entity. So since there is a transfer of resources, then it becomes a direct benefit to the entity or to the entities being granted these particular resources, and thus we can account for it because we know that it is specifically attributed to us as the entity. So these are resources transferred to the entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. So most of the time this is conditional. They exclude those forms of government assistance which cannot reasonably have a value placed upon them, and transactions with government which cannot be distinguished from the normal trading transactions of the entity. So the main thing that we need to understand with government grant is that these are given to us because of certain conditions that we have already satisfied in the past, or something that we are going to be satisfying throughout the duration of the grant. So meaning it is possible that there will be a piecemeal realization of the benefits of the grant, or there will be a one-time recognition of the benefit once all of the conditions are already met. Next, we have grants related to assets. Sorry. So grants related to assets are government grants whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire long-term assets. Subsidiary conditions may also be attached, restricting the type or location of the assets or the periods during which they are to be acquired or held. So when you talk about grants related to assets, this pertains to resources that are given to an entity for them to be able to purchase, construct, or otherwise any type of acquisition of long-term assets. That's why it is called grants related to assets. Okay? Next, we have grants related to income. So grants related to income are government grants other than those related to assets. So it is a residual definition. So meaning any type of government grant that is not considered to be grants related to assets are already grants related to income. So by residual definition, that's how we define grants related to income. But of course, just for us to have an idea of what these are, generally um, these are pertaining to amounts that are given to us as the entity, given to us by the government, which will either automatically be reflected in our statement of comprehensive income, or it will be deferred first as a liability and then eventually going to be transferred to comprehensive income once we have already earned the rights to that particular grant. So that's basically what grants related to income means. Okay. Next, forgivable loans. These are loans which the lender undertakes to waive repayment of under certain prescribed conditions. So in this case, forgivable loans wherein the lender is now the government, okay, and of course we are the borrower. So if there are forgivable loans wherein the government will now waive the repayment, then it becomes part of government grant in our case, as the borrower whose repayments has already been waived. Next, fair value. So again, similar to what we discussed previously, we already specifically said that fair value will always be pointing towards IFRS 13 unless a specific provision provided in the standards in the standard states otherwise. So in this case, fair value is important, particularly in the valuation of the grants that are given to us by the government. And in the case of determining the fair value, we will of course go back to the provisions of IFRS 13 fair value measure. So with that, let us proceed with the provisions of the standard with regards to government grants. So government grants, including non-monetary grants at fair value, shall not be recognized until there is reasonable assurance that. So in the case of government grants, both the requirements should be satisfied. First, the entity will comply with the conditions attaching to them, and the grants will be received. So these are the two requirements that needs to be satisfied prior to us recognizing the government grants. And when we say recognizing the government grant, it may pertain to it being recognized as an asset with a relating liability to the particular journal entry. It is also possible that it is going to be a debit to an asset with an asset which is not a non-monetary asset. In this case, it could be cash, but it will be subjected to either a credit to a liability or a credit to income automatic. So that depends on the conditions attached to the government grant. So in addition, government grants shall be recognized in profit or loss on a systematic basis over the periods in which the entity recognizes as expense the related costs for which the grants are intended to compensate. So meaning, the recognition of income for government grants is dependent on the underlying component of the operations of the business that relates to that particular grant. So example, if the grant is relating to the construction of a PPE or a construction of a property, plant, and equipment, the recognition of the government grant as income will be systematically spread over the life of the property, plant, and equipment where the grant was applied. So that's basically how it works. So, meaning, if the PPE will be depreciated over a straight line basis, then the government grant will also be recognized in profit or loss in the same basis as the depreciation of the PPE. So meaning, straight line to straight line, SYD to SYD, double declining to double declining, or any type of depreciation. So this is the reason why in the case of government grants, it is most of the time more practical for you to use the net method, wherein we will net off the amount of the grant to the value of the asset that we are constructing, so that the depreciation will now be net of the related income. So meaning there will only be one account or one amount that is reflected in the financial statements. But anyway, we're going to discuss that in detail later on. The concept here is that the amount of expense or the amount that will be reflected in our statement of comprehensive income will be based on the pattern or the systematic pattern that is applied also to the operations or the asset that it is trying to compensate. Next, this is where we emphasize already on the two methods. We have the capital approach and we have the income approach. So when you talk about capital approach, this is pertaining to the net method. So meaning we are going to net off the value of the grant to the underlying asset or to the underlying item that is related to that grant. While in income approach, we are going to recognize the grant as a separate income or a separate line item of income in our statement of comprehensive income. So anyway, let us first go to the capital approach. Before we move on, let me just emphasize that regardless of whether you use the capital approach or the income approach, it's still recognized as a correct application. So this is a matter of this is just a matter of accounting policy choice. So if you choose the capital approach, it's okay for as long as you disclose that in your notes or you disclose that properly in your financial statements. If you want the income approach, it's also okay for as long as it is properly disclosed. So the argument that supports capital approach are as follows. So first is that government grants are financing device and should be dealt with as such in the statement of financial position rather than be recognized in profit or loss to offset the items of expense that they finance. Because no repayment is expected, such grants should be recognized outside profit or loss. So, the second one, before we move on, it is inappropriate to recognize government grants in profit or loss because they are not earned but represent an incentive provided by government without related cost. So these two are the arguments that supports capital approach. Again, this does not mean that the other approach is already incorrect. What we simply try to say here is that this is the reason why the standard allows the use of capital approach. So again, what do we mean by the capital approach? We will have other examples in the related videos that are going to be attached to the playlist of this video. But basically, when you talk about capital approach, we net off the amount. Okay? We net off the amount that we receive as a grant to the cost that we incurred in the construction of the asset or in the related asset that we acquired. So basically, that's how it works. And because we are using capital approach, there will now be a single amount that will be reflected in your statement of comprehensive income, which is the depreciation. So that's how it works. Because there are no government grants that were deferred and that will be recognized in profit or loss as income, the amount will now be a net amount in depreciation, which is going to be a lower amount of depreciation. In the capital approach or the income approach, however, they argue that because government grants are receipts from a source other than shareholders, they should be recognized as items that are not directly related to equity participants but will be recognized as profit or loss. Because basically, the government is an unrelated party to the entity. So, this is the argument between capital transactions or investment transactions and your income transactions or your revenue generating transactions. Letter B, government grants are rarely gratuitous. The entity earns them through compliance with their conditions or meaning the conditions of the government and meeting the envisaged obligations. They should therefore be recognized in profit or loss over the periods in which the entity recognizes as expense the related costs for which the grant is intended to compensate. And finally, because income and other taxes are expenses, it is logical to deal also with government grants, which are extensions of fiscal policies in profit or loss. So these are the arguments that support income approach. So anyway, what is going to be the practical effect in our financial statement? Because we are going to recognize the government grant as income, the effect is therefore in your profit or loss, there will be two items to be reflected. One reflecting the expense and number two reflecting the portion of the government grant which is recognized as income. As compared to when we use the capital approach wherein the two amounts are already netted off and therefore we only have an expense account that is lower in amount because it is already net of the income. So to just to give us an idea, anyway, there will be examples in the next videos. The concept is basically like this. If let's say for example, we're going to use the capital method, if the total cost of the property is 2 million and you were given by the government 1 million as government grant, then the net amount is only 1 million. If the useful life is 10 years, 1 million divided by 10 years is going to result in 100,000 per year. So the net amount of depreciation that will be recognized in your statement of comprehensive income will be 100,000 depreciation expense. If we will use the income approach, this is what will happen. We recognize the 2 million cost in the asset or in the PPE. If in this case, in our example, 2 million gross amount and then 1 million also gross amount in your deferred income because it is not yet earned. So, over the 10 years, the 2 million will be depreciated divided by 10 years. That's going to be 200,000 expense per year. And the deferred income, which is 1 million, will also be spread over based on the depreciation rate of the asset related. So 1 million divided by 10 years is also 100,000. So there will be 200,000 depreciation expense and 100,000 income from government grant. If we net off that amount, it's also going to result in 100,000 expense, which is the same as the depreciation that we are going to get if we are going to use the capital approach. Okay? So by the way, there are other authors that use a different term. For capital approach, they use net method because we are netting off the amount of the grant to the overall cost. And income approach is called gross method because we do not or we consider the two transactions, although they are related to each other, as independent transactions. So depreciation in this case will be gross, okay? And then income will be gross also. Now, there is also going to be grants relating to income later on, which is also going to recognize either the capital approach or the income approach. Okay, so anyway, we go to the next portion. So a government grant that becomes receivable as compensation for expenses or losses already incurred or for the purpose of giving immediate financial support to the entity with no future related cost shall be recognized in profit or loss in the period in which it becomes receivable. So this is very straightforward. If you are given a grant and there are no more conditions attached to it, so this is simply an amount given to you to recover those that was already incurred prior or in the previous periods. Okay, so there it means that there will be no more spreading over of the benefit of the grant. It is going to be recognized in full at the time it was received. For example, the entity suffered losses due to fire, and then the government gave compensation amounting to 3 million to the entity. The 3 million will be automatically be recognized as an income at the time it was received. Because basically, the purpose of that is to compensate for the loss relating to the fire that the company sustained or the entity sustained. So, again, you might be arguing, sir, isn't what if the fire happened last year and then the grant happened this year? Are we going to recognize the grant rather in or make an adjustment in the previous period? The answer is no. Because take note, we recognize the grant on the date it was received or on the period it becomes receivable. So it is specifically provided for in the standard. So there will be no change in account or there will be no prior period errors or any adjustments in the prior years. Next, we go to non-monetary grants. Okay? So, it is possible that the grant will be in the form of cash or it can be in the form of non-cash assets or non-monetary grants. So, in this case, if a government grant, okay, takes a form of transfer of non-monetary assets, examples such as land or other resources, okay, in this case, what's going to be the accounting for or the accounting effect? In these circumstances, it is usual to assess the fair value of the non-monetary asset and to account for both grant and asset at the fair value. An alternative course is it sometimes follows is to record both assets and a grant at a nominal amount. So this is the usual discussion even when you were in the lower years, wherein when you receive a non-monetary grant, you need to recognize it as an asset and as a deferred income. So there will at the fair value. And then what you're going to do is you're going to depreciate it over the time if it is a depreciable non-monetary asset, or you're going to recognize it later on upon the sale of that particular non-monetary asset. An alternative is you recognize it at nominal amount. In this case, it is simply stating that you just disclose the non-monetary grant because anyway, um, there will be the effect will be the same. So just to justify the concept is like this. If let's say for example you were granted a building. Okay, let's say for example, so we recognize the building at fair value. So let's say it's 5 million. So the building will be debited as a debit to building 5 million, and then a credit to, if let's say for example it is there will be no conditions attached to it, it will be an automatic credit to income from government grant. And then of course, since you have the building, you need to depreciate it over time. So the depreciation will be recognized as an expense. So the grant that was recognized as income will also be recognized as a decrease in your statement of comprehensive income in the form of depreciation. So net effect will be zero. And that is why, as an alternative, you can also use the nominal approach wherein you just disclose the grant that was provided. Because anyway, at the end of the life of that asset, the net amount will also be zero. Because the income and the expense will have a net effect of zero. Okay, so that's basically the concept why, as an alternative, you are allowed to use the nominal amount. But of course, the reason why the fair value approach was first provided is because it is being encouraged by the standard for entities to use the fair value method for better disclosure or for a more comprehensive disclosure. Okay, so that's basically the case in this one. Okay, so now we go to presentation of grants related to assets. So government grants related to assets, including non-monetary grants at fair value, shall be presented in the statement of financial position either by setting up the grant as deferred income or by deducting the grant in arriving at the amount of the asset. So again, if you will recognize a deferred income, this is the gross presentation, also known as the income approach. And when you deduct the grant in order for you to arrive at the carrying amount, this is known as the net method, net presentation, or the capitalization approach. Okay? So, what if there is now repayment of government grants? So, there is a possibility that a grant that was provided to a company will now be demanded by the government for you to repay it. So the reason is because, let's say for example, you were not able to satisfy the conditions or you violated the provisions of the grant or any other case. The concept is basically you are now being or the government is now demanding that you repay the grant that was previously provided. So in this case, A government grant that becomes repayable shall be accounted for as a change in accounting estimate, and the repayment of a grant related to income shall be applied first against any unamortized deferred credit or the deferred grant income, which is a liability recognized in respect of the grant. To the extent that the repayment exceeds any such deferred credit, or when no deferred credit exists, the repayment shall be recognized immediately in profit or loss. Repayment of a grant related to an asset shall be recognized by increasing the carrying amount of the asset or reducing the deferred income balance by the amount repayable. So this is very straightforward. So anyway, before we discuss, let's have the last portion. The cumulative additional depreciation that would have been recognized in profit or loss to date in the absence of the grant shall be recognized immediately in profit or loss. So what does this mean? This simply means that upon repayment, you need to determine first how much you're going to pay, because that will be the amount of the credit to cash that we're going to pay. So if let's say, for example, the total amount that is being demanded by the government is 15 million. So we are going to credit cash of 15 million. Okay? The next thing that you're going to do is determine whether there is still a deferred balance of the grant, which is part of the liability, because we are going to derecognize that. So that will be part of our debit side. Okay? So the credit is already clear. The credit is already the amount of the cash that we're going to pay back to the government. The first debit that you're going to determine is the amount of the deferred credit that is still recognized in the liability section. So if let's say, for example, there is still a deferred credit of, if out of the 15 million, the deferred credit is, let's say, 10 million, then there is still a balance of 5 million. So the question there is, what is now the effect of the 5 million? So if that is pertaining to a previously subsidized income, then the debit will be additional expense. If it is pertaining to an asset, then it is going to be an amount that is going to be recognized as an increase in the value of the asset net of the previous depreciation. So it is more difficult in the case of assets because one, you are going to determine the gross amount that you're going to add back to the asset. And number two, you're going to determine also the amount that is related to the amount that will be recognized to profit or loss for the additional depreciation. So meaning you're going to have a work back on the computation. Anyway, we have those examples in the next part of this particular lecture. So with that, we now proceed with government assistance. So it says in the provision of the standard, excluded from the definition of government grants are certain forms of government assistance which cannot reasonably have a value placed upon them, and transactions with government which cannot be distinguished from the normal trading transactions of the entity. So since it cannot be provided as a grant, then it is now going to be covered by government assistance. So what are examples? It says here, examples of assistance that cannot reasonably have a value placed upon them are free technical or marketing advice and provisions of guarantees. An example of assistance that cannot be distinguished from the normal trading transactions of the entity is a government procurement policy that is responsible for a portion of the entity sales. So basically, in this example, yes, the entity was able to generate sales, but the generated sales is actually from a government procurement policy. So this came from a bidding process. Now the question is, did we or did the entity generate sales because of an assistance of the government, or is it because of the normal operations? Because you winning the bid, okay, can either be a grant or an assistance or a normal trading process. So anyway, this is one of the reason, or these are some of the examples why government assistances are only disclosed. because you do not know the direct impact of these particular transactions. Because in the first place, we do not know if it is really an actual benefit coming from the government, or is it going to be a process that's going to affect everyone who will transact with the government. So anyway, the existence of the benefit might be unquestioned, but an attempt to segregate the trading activities from the government assistance could well be arbitrary. So we do not really know. That's why we do not account for the assistance portion. What we do is we simply disclose. Okay? So example, you generated sales from a government contract. So you simply disclose that. What did you do? Was there a bidding? How were you able to generate those sales, etc., etc. Okay? So that's basically the discussion for government assistance. So by residual concept, if you cannot account for the item as a government grant, then you disclose it as a government assistance. That's simply how you're going to do it. Okay? Now we move on. We go to the disclosures. So the following are the disclosure requirements for the standard. So first is letter A, the accounting policy adopted for government grants, including the methods of presentation adopted in the financial statement. So this is whether you are using the capitalization method or the income method, gross presentation, net presentation, whatever term you're going to use. But of course, it is more advisable for you to use the terms used in the standard. Letter B, the nature and extent of government grants recognized in the financial statements and an indication of other forms of government assistance from which the entity has directly benefited. Okay? So, for government grants, you need to recognize the nature and the extent. So, meaning, what type of grant is this and how much did you earn or how much was given to you, what are the conditions, etc. And for government assistance, you simply disclose, okay, what benefits you were able to get from it. Although might be indirect, still you recognize it. And letter C, unfulfilled conditions and other contingencies attaching to government assistance that has been recognized. And of course, this is not related to the assistance only. You should also recognize the conditions that were not yet fulfilled in the case of government grants. So to simply put it, you provide all the details of the grants and the assistance that you were able to get from the government. We have the transitional provisions because generally we do not everyone will have a government grant immediately. Even if you are already using IAS or IFRSs, it is of course never automatic for an entity to use the standard if they are not involved in a government grant. So for transitional provisions, it says here, an entity adopting the standard for the first time, meaning it is the first time for you to have a government grant or assistance, must do the following. First, comply with the disclosure requirements where appropriate, meaning the disclosure requirements set in the previous slide, items A, B, and C. And letter B, either adjust its financial statements for the change in accounting policy in accordance with the IAS 8, or apply the accounting provision of the standard only to grants or portions of grants becoming receivable or repayable after the effective date of the standard. But of course, in this case, when you have government grant transactions for the first time, most probably you're not going to use the first item. You're going to use item number 2, which is to apply the standard to grants that you receive from the time, because of course the standard is already in effect earlier in previous years already. In fact, this has been a very old standard, and there are very minimal revisions to this particular standard. So the thing that you're going to do is, of course, apply the provisions of the standard in transactions from the time that you have government grant transactions. So most probably it is very remote for you to use item number 1, which is to adjust the statement or adjust the financial statements, because generally, if it is going to be pertaining to transactions that happened now or that will happen in the future, there will be no more change in accounting policies because the policy has been in existence already since way before the current period. So generally, you're going to do number two. That's why it's called transitional provisions. This is because it is possible that you already have a government grant prior to the existence of this standard. Okay? But of course, since the standard has been in effect for the longest time already, the most probably you will not do number one anymore. You will just do number two. Okay? So with that, that's the end of the presentation for government grants. So the next parts of the playlist of the videos will have the discussions and the problem solving questions also.